And transfer pricing is always going to be a sticky of a problem because you're selling to yourself. So if you have a subsidiary and that subsidiary sells you stuff, or you sell stuff to the subsidiary, you're really selling it to yourself. Okay, you say, well, who cares then? You're selling it to yourself. It doesn't really matter. Which is kind of true, except there's a few things that come into play. One of the things that come into play is, that subsidiary, how well they do, their profit is based on, what they sell to you or what you sell to them. I mean, either revenue or cost is going to be, or cost of goods sold is going to be one or the other. So there's this dependency on that, and that they may have bonuses and all kinds of stuff tied up in that. Even a bigger problem or / opportunity is when you have it in different countries, because not only do you have this problem of what's a fair price to transfer it, back and forth between these two, but there are also things that can come into play, and that is that different countries have different income tax rates. So you may rather have your income picked up in a country with a low income tax rate rather than a high income tax rate. So you also have this other thing that kind of comes into play, and there's also things like tariffs and duties going between the countries. There's all these other things that come into play that make the transfer pricing. There can be other objectives rather than just being a fair price between, two people in the same family. So this transfer pricing, it's always difficult. And I can tell you that some of the biggest arguments and stuff that you have in companies is over stuff like this, because it's people's livelihoods basically. Okay, well, we basically have 3 different kinds of transfer pricing, and we have the cost-based ones, and about 41% of the companies use this. We have market-based ones, which are probably theoretically the best if you can use them. You can't always use them. And then we have kind of a negotiated price one, which is a little bit like the market one, but it's it's when hopefully that the subsidiary has a little bit more bargaining power. So we'll go through each of these and kind of see what they're talking about. Okay, cost-based transfer pricing. Transfer price based on cost to produce could be fixed costs or possibly a markup, cost plus pricing. The opportunities are, and this is a big one, that you can find a transfer price that meets your own objectives. So the cost, because you can basically make it anything you want, but you can make it so that it whatever objectives you have for the company, and it may not be, it may be to reduce taxes or something like that, that you can actually control it. Potential problems. What cost to use? There's all kinds of costing. There's a really old accounting joke that someone asks, well, how much does this cost? And the accountant says, well, what do you want it to cost? Because there's so many different kinds of costing. You can come up with about anything. Okay, a lot of times there's no incentive for the division to manage the cost because they get passed on to the next group. So inefficiencies can be passed on to the subsidiaries. So there's no incentive for selling division to manage the cost. So and you come down here especially, and this is what you probably have run into this in your econ classes and that, about cost plus. So, this might be something like this. cost plus 25%. So you take the cost and you tell yourself doing a cost plus 125%. So if it costs $100, let me do this down below. Plus 25% of the $100. What are you doing? So you end up with a transfer price of $125. So this is cost plus. Now, here's the problem with cost plus. If you want to be more profitable, you increase your cost, which is generally not what a company wants to do. So if you increase your cost to $120, now it's 120. Now, what of that is what? 30. So now the transfer price is 150. So the more expensive you can make something, the higher you can sell it for, the cost plus. So it can be very problematic in that there's this built-in incentive to increase cost instead of cutting costs. You have the cost plus. You know when they did this was recent, they overhauled the Affordable Care Act thing. They said that the insurance companies that they could only keep 20% of the whatever for institutional charges. Well, what does that tell you? If you want to increase your institutional charges, what do? You increase the cost. So we still have stuff like this around. It's not like it's going away, but this is the part of the problem with cost plus is that it leads to inflation, cost jumping up because you're just gonna transfer it on. And notice if you're transferring this onto another division, it's just gonna make the other division look terrible. And basically, look terrible because of your decisions. Okay, market-based transfer pricing. This is probably the best one. It is also probably the most limited one, and you can't always use it. And it's basically what would be the price would be charged to unrelated parties. Sometimes called uncontrolled parties. Okay, potential opportunities, avoids and inefficiencies. So if you're up here and if this item really sells for $90, well, then the parent company has to get their act together and get the cost down. So it avoids inefficiencies and helps ensure divisional autonomy, and that you can actually go to a price that is market-based and use that for your pricing, and it keeps everybody honest, basically. Potential problem. Must have an efficient market to get a good market price. There are some things that are priced all over the place. So getting a good market can be a real problem. And this one down here especially. Unfinished or unique items may not have a market price. So if you have something that's very unique, it's hard to get a market price for it. And this is especially true for you. A lot of times you have parts or something like that that are very unique. You have a part that can only be used in a GM minivan. Well, I don't know, whatever it is. But anyway, it's hard to find a market for that because there's only one. And there's probably not a lot of people making it. So it's really hard. You really hard to find a market sometimes for things that are very unique. So when it comes to transfer pricing, that's is a problem. Even though the market-based transfer price is probably theoretically the best, a lot of times you just can't find a market for them. And negotiated price. Now, negotiated price is usually when they the transfer price is a result of negotiating between a buyer and seller. A lot of times you can have companies that will tell their divisions that they'll say, look, you don't have to buy from us, you can buy from somebody else. I'll tell you a funny one like that in a second, but the idea is, well, you guys are giving us these products, whatever they are, and they're very expensive from you. We can get them a lot cheaper in the market. And the parent companies will, to make it more efficient, they'll say, we'll do it, go to the market. And, so a lot of times these transfer prices that they will be negotiated. And a lot of times just when you give the divisions a little bit more autonomy. I'll tell you a funny one though. When I was doing an audit, there's what's wrong here? I'm getting shorter. The camera got moved. I worked for Navistar, and we had an engine assembly plant in Melrose Park, and we would buy. The company would make pistons, and they'd be delivered to the factory, and in the factory they would put the pistons in the engines. And they were complaining that the cost of the pistons was too much. They could get them cheaper. So they said, okay, we'll get them somewhere else. And what they ended up doing, there was a contract that got what they call orphaned, that they were selling some pistons to an engine rebuilder that literally the contract hadn't been changed in 10 years. So this engine rebuilder was getting these pistons for like half of what the cost of making. And we kept selling them to them. It was such a small thing, and no one was taking care of the account. And a handful of pistons wasn't that much, that no one would notice. And pretty soon they got huge orders from this little engine manufacturer because our entire assembly plant was trying to buy our pistons that we were selling to this guy for under cost. They said, well, wouldn't it be faster just to write the guy a check? But anyway, they looked at the contract. Oh, those aren't $18 anymore. Those are $58 or whatever. But we were actually selling to somebody else who was selling it back to us for cheaper. Not a proud moment, but Okay. Okay. Interaction of transfer pricing methods and objectives. The cost-based methods are important when the following are there. Differences in income tax rates. Minimization of import duties. Oops. Or tariffs. They're kind of the same thing. Actually, I talk about them a little bit later on here. Foreign exchange controls and risks. We'll talk about a little bit more later on. Restrictions on profit repatriation. I think we'll talk about that now. Risks of expropriation and nationalization. I'll talk about that too, I guess. Okay. Sometimes it costs money to bring your money back into the United States. They have some rules on profits, and when you have profits that weren't taxed and you bring them into the United States, they're going to get taxed. So you don't want to pay that tax. And so what you do is, instead of bringing that money back in the United States as cash, you simply charge more for your products. You're still going to get the cash you want out of that company, but it's going to come back in as a sale and not profits that are going to get taxed separately. So, the idea is how to get cash out of the place is one of those things. Also, another thing is a lot of times if there is a high inflation rate in the subsidiary, charge a high price, you bring those back into American dollars really quickly by increasing the price, and by that way you keep changing that money into US dollars. Okay. Expropriation and nationalization. This is when a local government will take over a business. And sometimes it was for good reason, sometimes it's not. But regardless, if you're worried that you get this assembly plant or something, and you're afraid that this, the government is going to take it over, you may charge a lot higher price for a couple of reasons. First of all, it's going to make that company look less profitable and less likely to be attempting, takeover by a government. Governments generally don't want to jump into losing propositions. And secondly, just to get the money out of there in case when it, if and when it does happen, you'll be less exposed to, as opposed to having a bunch of the foreign currency tied up in the place. Oops, that's not where I'm going. Okay. Okay, market-based methods, when followed, are important. When the following are important, interest in the local partners. One of the things about this risk of expropriation is when you have a partner and you're not being fair with the partner. And there are, I don't know if this is still the same way, but in India. Okay, in India, they have laws that you can't do things unless there's a law that permits you to do it. I guess for business, anyways. And they have no law that foreign interests can directly invest in India. You have to get an Indian partner to join with them to invest in for instance, if you want to make an assembly plant in India, you got to find someone who's already in business in India, and you have to go in with a joint venture, basically. So you have a partner there. So finding a fair transfer price is a good idea for to be fair with the partner, and that will also lessen the likelihood that you're going to have a government take it over. And I was a good relationship with the local foreign government. So again, these kind of go together. Okay, now, so this is, so far it's been kind of like the good government speech. Now it comes into a little bit more the nitty-gritty of it. Performance evaluation. Obviously, the price that you transfer it at is going to have an impact on the subsidiary and the parent. And you may very well have people whose livelihoods are based on that. They may get bonuses based on that. They may get raises. They may, worry about getting the division closed down because of the transfer pricing. So it's very good that you have a fairness of the transfer prices. And, this will have a huge effect on satisfaction on managers. I had a friend that worked at a company that was taken over, and immediately the parent company just dumped a bunch of corporate overhead on them, basically. And they had a pretty profitable company, and their division was pretty profitable, and then all of a sudden it became unprofitable. None of them were going to make their bonuses and all that kind of stuff. And he said, the whole office environment just crumbled. There's people that were quitting every day, and there were, and it just, it really just fell apart really quickly. And it happened just because of, all these shuffling around of numbers, basically, that it does have an impact on people. Okay, now this is probably one of the biggest ones that we are going to talk about in this, and this is cost minimization, also called profit maximization. Okay, And this is because you can manipulate the prices, that it's possible that you can achieve a cost minimization. Now, usually these go hand in hand with some kind of a sharing with the other company of the, they get some kind of a profit sharing of the corporate or things like that. But so cost minimization. And what do you try to reduce? These. Try to reduce the taxes, the imports, duties, and the tariffs. So all those things, you try to reduce them. And you do reduce them by shuffling the numbers basically on in the transfer price. This is referred to as discretionary. So you have control over it. It's not market based. It's simply to try to make yourself either profitable or unprofitable, or try to avoid tariffs in one way or another. Another approach is to avoid withholding taxes. And I think I just went through this. Maybe I didn't. Okay, kind of, it's a similar idea. For instance, let's say a foreign government that they charge taxes on dividends. Okay, so if the company pays you dividends, you're going to have to pay taxes in the foreign country. Instead of having them pay dividends, just add whatever you have for the dividends, add it into the pricing model. So they pay you basically a cost, to them, but it doesn't come out as dividends. We try to talk about most of this. Oh, sometimes it goes the opposite way. This is kind of going on in China right now. And that is when you try to break into a market. Sometimes it costs money to break into a market. And so what you do as a transfer pricing is you reduce the transfer pricing considerably so that your subsidiary has an advantage. And the idea is to get a toehold in it. And a lot of companies are doing this in China. They're trying to get a toehold. China's a huge place, fast growth, all this stuff. And so a lot of these companies are either buying subsidiaries over there or establishing subsidiaries over there. And a lot of times they lose money, at least initially anyways, they lose money. And what they try to do is, hey, we got to get a toehold in here because in the years to come, this is going to be really big and we got to, so even if we're losing money, we might make our subsidiary, help our subsidiary as much as we can to be successful over there. Get as many clients and all that kind of stuff. Okay, income taxes and import-export duties and tariffs. Duties and tariffs are fairly similar. They're taxes. And generally, the taxes are a little bit different. The tariffs are basically paid on the items themselves, and they're paid to U.S. Customs and Border Control. Duties are just like regular taxes, kind of like a sales tax. And both of them are often used for political measures. So a lot of times you'll have, things that are not necessarily happening because of fair trade. They're happening because of different things. Protecting local companies, consumers, protecting new industries. You're trying to get, like automobile batteries. I think is a big thing that they're trying to get. The new thing is how do we make batteries? And they're also used for retaliation measures. And this is an important one too. Because a lot of times, to get these tariffs, people go say, whoopee, we got this tariff and now, we'll have more people working or whatever. Well, a lot of times you have retaliation. The retaliation is aimed at whoever. And so a lot of times, you get into these kind of, we went through this with China a few years ago. You raise the tariffs and they raise their tariffs a bunch, and you raise your tariffs a bunch, and you get these what they call tariff wars. When I was growing up, we used to have tons of them. No, we didn't have them for a long time. Now we're back to having more of them. But and sometimes you get outrageous. You get 100% tax on stuff and things like a tariff on stuff and all that kind of thing. But because of that, a lot of times people who are a little more level-headed in business, they try not to irritate whatever foreign country they're in. It doesn't make sense to do it because, again, you can have these tariffs. So a lot of times they try to keep on good terms with the countries that they're dealing with, because of these retaliations. Again, they don't really help anybody. Okay. Tariffs are imposed on goods exchanged between countries. Import tariffs and export tariffs. Duties are exchanged between countries and between states. So this is an interstate thing too, you can have. Coming down here, you have customs duties, but this is one you'll see commonly, the excise duties, and you'll see that those are on things that travel across straight lines, gasoline, tobacco, all this kind of stuff. A lot of times they have excise taxes on them, and those are taxes between, in the United States, but between states they have them. Okay. The taxing administration of U.S. and foreign governments are not stupid, and often shifting profit from one company to another to avoid taxes will trigger an offsetting export duty or tariff by a country. So a lot of times, you get lawyers and stuff involved in this, and after doing all this work to try to shift where you make the income and all that, a lot of times it's all for naught, because again, countries aren't stupid, and they will simply say, okay, well, we're going to slap an export tariff or an import tariff or whatever we have to do, because we're not simply going to let you take advantage of us. So a lot of times this is, this maneuvering is not as productive as you might think it is, or as it's presented. Okay, anti-dumping tariffs and duties. Anti-dumping duties and tariffs are typically levied when a foreign company is selling at an item at significantly below either the price at which it's produced, so they're selling it below cost, or below the price that they sell it for in their own country. So these are kind of the two situations you come up when they talk about anti-dumping. Now you might wonder, well, wait a minute. Why would you complain about that? They're selling you stuff really cheap, like less than cost. Isn't that what you want to have? The problem is, it usually happens when there's overproduction. And now, let's say that you're in wherever, Germany, and you're making steel, and you figure out that the market is, you're overproducing. That makes the cost of steel drop or become erratic. That it's headed in a bad direction. So what do? You take a certain percentage of your steel and you sell it overseas for whatever you can, even if you're taking a loss on it, because you don't want to disrupt your local market. You want the German steel market to be nice and secure and have normal prices and normal profits and all that. And if you dump it in someone else's market, it just creates havoc in their market, not in yours. So that's what dumping is. And if you're wondering why do you care if someone's selling something for too cheap? Well, it usually disrupts the market. And what happens a lot of times is it disrupts the local producers. You can imagine if you're a steel company in the United States and all of a sudden a bunch of really cheap steel comes over, well, you're not happy about that, because now the market has changed. Now it's because of overproduction in Germany, now it's your problem that you're going to have this excess production. By the way, I worked for U.S. Steel. When I was there, we had a lawsuit where we sued ourselves. Kind of a strange one. We had a joint partnership with a Korean steel firm. It was out in Oakland, California, and I actually went by it. It's kind of a neat looking place. But we had this joint venture with them, And then the US companies all got together, including US Steel, and sued because of for dumping practices by the Korean steelmakers. And because we had this joint venture, our joint venture was sued also. So we were both the plaintiff and the defendant in the same case. I don't know which side we actually choose to root for. We probably were kind of indifferent. I don't know. When one you lose one, there's nothing you can do about it. But we actually sued ourselves because of the joint venture. Okay. Method for assigning a transfer price. Okay, the first one we're going to talk about is the comparable uncontrolled price method. I don't like the term uncontrolled here. That's what they use in the book. I'm going to use unrelated is what it is a better term, I think. Uncontrolled sounds like it's all nutty, whereas unrelated is really maybe the better way to put it. Uncontrolled just means you don't control it. But the term uncontrolled can also mean that it's out of control, and that's not what they're talking about. They're talking about that it's unrelated. So this is when you sell something to someone at an arm's length. And this is probably one of the, certainly one of the market ones, and this is a good one because it establishes a price that is fair, basically. So the comparable uncontrolled price is a price at which manufacturer sells the same product to an uncontrolled, unrelated distributor in the same country. In other words, arm's length transaction. All right, an example, ABC sells mufflers to a subsidiary in Canada. ABC company also sells mufflers in Canada to various unrelated auto parts stores for $115. The $115 would be the comparable uncontrolled price. And again, it's probably more better to say unrelated price. So if you're selling it to everybody else for $115, that's probably a good price to sell it to your subsidiary. It's a fair price. Other people are paying it, so it's probably a fair price. You know something weird? Canada makes like half the mufflers in the world. Like of all the cars all over, it's unbelievable how many cars, if you look underneath them, if they're mufflers, it'll say, made in Canada. There's tons of them are made in Canada. Almost all the US cars, the mufflers are made in Canada. I don't know why. I wouldn't think there'd be any particular reason why. But anyway. Okay, resale method, price method. Now this is used generally when they're simply the item is simply passed on. They don't really do much with it to change it. So the repo price is typically when the buyer seller is merely a distributor of finished goods and does not add a substantial amount of value to the product. So this is kind of like almost like a pass-through that you kind of give it to them. They don't do much with it. They just sell it. Now they might do something little with it, like repackage it. If you're selling something to wherever, you're selling something to Thailand. You probably want to have it, their local language and that they might repackage it, but basically they sell it on. They don't really change the product or anything like that. And what you do is you say, okay, well, what are normal, what are we going to sell these for? And what's the normal markup for something like this? Okay. So resale price method. The resale price method is used to rate a reasonable gross profit by referring to the gross profit normally earned in retailers in the same market. Now, you might say, well, how do you find that out? With the public financial statements, publicly traded companies, they'll have financial statements. You can see what their markup is. Basically, look at their cost of goods sold compared to their sales, and you tell what their markup is. Depending on what industry they're in, it might be harder than some, but a lot of times the gross profit a lot of times is not as hard as you might think to obtain. And there's analysts that put out stuff like that too. Okay, so here's an example. ABC sells mufflers to subsidiary in Canada. ABC company does not sell mufflers to any other entity in Canada. Okay, so we can't get a market price. We can't get a uncontrolled or unrelated price up here. But we do know they sell the mufflers for 160, and typically the markup in Canada is 25% of the selling price. So what are we going to sell it to them for? 160 minus their normal markup. They're going to make is that like $40? Oops, too far. So 160 minus 40. I think that's right. 120. So this would be the selling price. Okay. Cost plus method. Again, this is one of those methods that can sometimes be bad because it encourages the cost to increase. Hopefully the parent company or whoever's selling it, they have some control over the cost. It is very likely they do, but yeah, so cost plus. Okay. So ABC sells mufflers to a subsidiary in Canada. ABC does not sell mufflers to any other entity in Canada. The mufflers cost ABC $90 to make, and the usual markup is 30% of the cost. Okay, so 90% to make, plus they add 30%, which is 27. And so this is the transfer price. So again, these different methods, and there's different times to use both any of them. Now, the one thing I would talk about though is this. Sometimes the items are just sold right on. You know, you make something and it gets sold without being modified. So it goes from one entity, they sell it to another one, and it's kind of like Walmart. You know, you put it on the shelves, it sells, it goes. You know, that's it. It's different if you have something that is built into a bigger product, basically. So if you're selling mufflers to an assembly plant, it's a little bit trickier because that muffler is not being sold separately. It's being put on a car and everything else is on the car. You know, thousands of dollars worth of stuff is being put on that car. It's very difficult to know what the market is for that. You know, because it's being put in with all of these other items that are all part of it. So it can be trickier when you have something that is not in its ending form. And that's kind of what we're talking about here. Okay, so you know, it could be hard to get a resale price on that because they're not reselling it. It might be hard to get comparable related price because maybe it's specific to that car. Maybe they're only selling it to that assembly plant. So a lot of times you end up with this cost plus method down here simply because it's the only one you can use. Okay, so problem number one. The imported item is unique and can only be used as part of a larger product. Which transfer pricing method would be whatever? Which transfer pricing method is appropriate? Anyone? Hey, you guys are sleeping, I can tell. Okay, I'll answer it. An imported item is unique and I'd be the cost plus method. Because you're not going to resell it, and if it's unique, it's probably not going to have a market that you can actually get for it. Okay, I think let's go ahead and take a break. We'll take a little break and then we'll come back to this problem two. So let's take a break and we'll say we should still get done a little early. We'll jump into the problems then. Okay, so be back. Okay. Information. Okay, so what we're gonna do for this one is do the 3 different methods. Is it here or not? Okay. Okay, so we have the following information, so 3 engines. And so these engines, they cost Forester $600,000 to build. They're sold to unrelated aircraft retailers in Mexico for $7,200. The unrelated aircraft retailers typically sell the engines for $10,000. And there's typical markup is 22%. And Forester sells the engines domestically with 25% markup. Okay, so we have to calculate which ones of these are, what would the transfer pricing be for each one of those? And you can expect one of these on the test, obviously. Okay. Comparable uncontrolled price method. This would probably have to do with this one. Engines are also sold to unrelated aircraft retailers in Mexico for $7,200. So that would be the sort of arm's length transfer price. Resale method. This is for someone who's going to take the item and sell it again to somebody else. And then we'll kind of look at number 3. They sell them for 10,000, and typically the markup on engines. This is just in general, not specific to ours. We know that they sell ours for 10,000, but so the 10,000, the typical markup on an engine would be 22%. So coming down here, this would look like this. 10,000 minus that 200. $7,800. And the last one is the cost plus method. And that we're looking at this here. The engines cost $6,000 to build. Forester sells engines domestically with a 25% markup on costs. Plus. So these would be our transfer prices under each method. As far as which method would probably be the most appropriate, it probably would be the cost plus. The reason being is that these are engines that are being put up for resale. You know, this is if you resold it, not if you put it back in, not if you're building it in an aircraft. And putting it in an aircraft is kind of a different market because it's, you know, obviously you have to hook it up and all that kind of stuff. So which one would probably be the best as far as matching what it's actually used for? It'd probably be the cost plus one. Because they're really not reselling it. Okay. Now for the wacky one. Okay, so Tyler Limited imports electric control units from Singapore subsidiary that are used in production of its remote controlled drones. Electronic drone units cost the subsidiary $20 to produce and $5 to ship. They use remote control units in their drones. They, not including the control unit, the other manufacturing costs are $35 per unit. And here's the income tax for each one of those. And the import duties. Import on the transfer price, the invoice price. Okay, so what we're going to do is figure out the income for each unit based on this information here. And we're going to do it two different ways. We're going to do it with a transfer price of $30 and see what it works out to. And we're going to do it at $40. See what it works out to. Okay, so let's take the US one. They sell these for the drones, they sell for $100. The import cost for the item, we have a transfer price of 30. The import duty is 25% of the transfer price. I should do this differently. Hold on. Let's go to 30, 50, and $7.50. The other costs were 35, I think. So this will give us our taxable income. That comes out to. All right. So our taxable income is $27.50. times 0.21. 577, I'll say 578. Ignore our tax rate, we don't have to worry about that right now, so 27 minus. $21. Okay. Singapore, now they're gonna have also their own income. They're going to, they sold these to us for 30. They didn't have any import costs, they didn't have any, the other cost they had was the $25. They had the, 20 to manufacture and 5 to ship. This shouldn't say US taxable, let's just say taxable income. All right, so it's $5. Singapore tax rate is 15%. And so this comes out to 4.75. $26.47. Okay, well, we're gonna do the same thing down here, except that we're going to do it with. The price being $40, so we're gonna change this to 40. The import duties are gonna change because this is now $40 times 25, which is 10. $50. Okay, so the taxable income here is going to be 15. 315. Okay. Coming over here. This changes to $15. This changes to 15. So 15 times 15 is 225, I think. I'm gonna multiply that so I don't it's something I would goof up. So 15 times 0.15, 225. Okay. So 15 minus 225. Okay, so comparing the two, initially when you look at this, you might say, oh, well, let's get as much profit in Singapore as we can because their tax rate is lower. But like I said before, a lot of times these import duties, they come into play. Excuse me. And when they come into play, they have a way of kind of leveling the field. And you can kind of see that here. It's actually, you're actually better off to have more of the income in the United States rather than in Singapore. And the real reason why is these import duties. Those get hit at 25%. So the higher that price is, the more profitable you make it in Japan, not Japan, Singapore, the more you're going to be paying in these import duties. And while they're close, you can see it's still better to have it more in the United States than in Singapore. And although it does sound funny, but it does sound funny. I don't know how to format it. Here we go. But you end up with more profit if you have the lower transfer price, even though they have a lower income tax rate. Oops. Even though they have a lower income tax rate, they have a because of the tariffs or import duties, whatever they call them. It's actually a little bit better to be in the United States. But again, that's what those tariffs do. They're made to kind of level the field. And no country is clean with them. Okay, so the Chapter 9 textbook problem, I think it's the Banff problem, is due. And then next week we'll do the multiple choice, and we might even do a couple of problems more out of this and then start it in on some of the new stuff. Hey, that's not me. Okay. Questions? All right. Have a good evening.